What is going on, folks? Ordinary Income back today. Today I want to do a little bit of differentiation between a couple things you're probably hearing if you do follow mainstream financial media outlets such as Bloomberg and CNBC. I have no problem with either of them, really. I don't mean that in a derogatory term, but I'm just saying if you watch those, there's two terms you most likely heard, and that is recession and in relation to recession, the stock market itself. In particular, they're making a lot of connections that if there's a recession, you're seeing articles like these, like income strategies that can help protect your investments from recession. You know, if you just type in, I guess, recession in stocks into your Google searches or your Brave searches here, you'll see like income strategies through recession-resistant tech stocks, all this, things to buy during recession, all that. And I want to clarify this because they don't necessarily have a strong correlation with each other, or let me rephrase that. They don't have a direct correlation with each other. They do have a little bit of a strong correlation, but it's not a direct one. In that you can have a recession without a stock market crash, and if you're curious what that looked like, go look at 2020. And you can have a stock market crash without a recession. Most commonly what happens is the stock market will go lower, and then we will notice we're in a recession. But that's not because the market itself has gone lower. It's strictly because of definition. So let's take a look at what recession even means in the first place. How do we know we're even in a recession? It used to be, in the definition that I was familiar with, was that there was a decline in real GDP, I think, for 2 consecutive quarters. One quarter is 3 months. So 6 months into this decline is when the recession would be labeled. Meaning exactly what you're thinking, that you wouldn't really know you're in a recession until you're 6 months into it yourself, which is weird. Now, this NBER, what is the National Bureau of Economic Research, they have a much more vague definition. They just define a recession as any significant decline in economic activity across the economy. It lasts more than a few months, usually visible in real GDP, real income, employment, industrial production, wholesale, retail sales. One quick thing, when it says real GDP, real income, rather than just GDP and income, that's including inflation. That means that you're taking into account how did GDP grow, but in regards to inflation. So if GDP is up 2%, but inflation was 5%, you really had negative growth at negative 3% because you have to take into account how much more expensive things became. So it looks at real GDP and real income. The problem with this definition, though, is that it's, like I said, it's vague. A significant decline lasting more than a few months. So again, with the old definition that it was decline in real GDP growth for 2 consecutive quarters, aka 6 months, you didn't really know you're in a recession until 6 months in. In this case, we're still not going to know we're in a recession until a few months in. Who's determining this? I think it's going to be the NBER, but it's a little janky how this will be determined if we are or not in one. You're going to be seeing a lot of people saying we currently are in one based on inflation, unemployment, and all that, or whatever. It's tough to say what we are when usually for the consumer, how do you know you're in a recession? Job losses, job market's not going to be great. Things will become expensive. Productivity is going to be going down overall. I would say look at those things for a consumer. How does this relate to the markets? I said that you can have a recession and not a stock market crash. You can have a stock market crash without a recession. Why in particular? So back to that GDP one, we'll see the most recent recession was 2000, well, it was technically 2020, but 2008, we saw once we went negative, we went back positive, and then 2 consecutive negative quarters, Q3 in 2008, Q4 in 2008, the depths of the recession. Then we got out of it here. Now, quick thing to note, we had a recession in 2008. It was, I think, officially labeled in Q4 of 08. And we technically got out of it in like Q3 of 09. The market did not start to drop in even if we were looking at this great chart, it did not start to drop in Q1 of 08. It did not completely rebound in Q3 of 2009. I'll take a look at that. If you ask me, how can you have a recession without a market drop? Look right here. In Q1 of 2020 and then Q2 of 2020. So we had I guess technically defined as a recession, and then we bounced out of it really quickly. This one's going to be interesting because I think the market actually did recover completely from this. But we can take a look at this 2008 example a little bit later. First, the bear market. What is a bear market? It's just when prices fall 20% from their most recent highs. It could be for whatever reasons, pessimism, negativity. Maybe people are just trying to get their money out. They saw great returns, and they're like, all right, I want to lock it in. But whenever you have a 20% fall from your most recent high, that is a bear market. So you can have this economic recession here and not have a bear market if prices of your equities don't fall 20%. If they fall 19%, you don't have a bear market anymore. You don't have it at all, actually. You just have a little bit of a drawdown. I guess that's the best way to label it. But with this example, I said you could have a recession without a bear market. You could have a bear market without a recession. On top of the fact that you're not going to know until you are already in there. We didn't have a recession because Q1 of 2008. Let's take a look at the SPX. Q1 of 2008 would be like March of 08. So we can go all the way back to March of 08. And we can see that by the time we're at March of 08, we hadn't even been in a bear market. We had only been down 17% from the highs. In fact, the moment we got down to 20%, this is going to be tricky, was about October of 08. When did we really get signaled that we were in it? Q4 of 08. Well, Q4 numbers come out in January 2009. So January 2009 was when we saw that we were in, or we officially were able to label it a recession. I think this got revised back to include Q1 of 08. But at the time, we didn't have it until 2009. When those numbers came out of Q4 in January, that's when we saw that we were labeled in a recession. The market had been entered into a bear market territory by October 08. So it was about 3 months ahead of time. That doesn't necessarily mean it's a forward indicator, but just shows that they don't necessarily always go hand in hand. They're not always going to be walking in tandem. But the moment we acknowledge we have a recession, we are also in a bear market, so to say, that stocks are having a terrible time. The reverse is true though as well. We technically got out of it in Q3 of 09. Those numbers come out in October of 2009. October of 2009, where were we? October of 2009, we had only rebounded. We'd rebounded a little bit. Well, technically rebounded a lot, but 09. We were still May 09, June, July, August, September, October is where we're right here. We're at 1,050 S&P 500 after being at 1,500 S&P 500. So we were still down a third. We still down 33%, clear bear market territory. We had not even recovered. In fact, we didn't recover. The stock market didn't recover from that high that was the tipping point of the bear market in 2007. It didn't recover until 2012, right here. While for our economy, we were saying that we recovered a little bit by 2009, we were out of the recession. We were back to economic growth. So I just want to point that out, that it's not necessarily something you can go in tandem. That I think those articles are a little bit tough to digest sometimes, that just because you have one thing doesn't necessarily mean the other is true, nor should you change your stance. Recessions are based on economic numbers. They're based on GDP, they're based on inflation, they're based on unemployment. Stock prices the idea is that they're driven by fundamentals, they're driven by those economic numbers. But those numbers, one, are lagging numbers. They represent what happened last quarter, not what's happening right now. Stocks are known to be forward-looking, so to say. But the idea is there's other factors that impact the stock price. In particular here, let's take a look at our economy again. Q2 of 2020, so those numbers came out in Q3 of 2020, which would be August, September, those numbers come out. We were shown that we were in the trenches of a recession in August. In August of 2020, we had already made a new high in the S&P 500, which was to show that if you were just using the stock market, you would be saying, hey, not only are we out of a recession, we're into new prosperity, new prosperous territory. That's not the case, because there's other factors that influence this. Monetary policy, fiscal policy, what do central banks do, how much is the government spending, and all that. Those impact the stock market, which you don't see those impacts happen to the economy, at least if it is supposed to impact the economy. It doesn't happen until a lot later than it does for the markets itself. So connecting the two things together and saying that, with one you'll have the other, I think is a dangerous game to play. I think it's a little bit tricky. You'll find yourself in a tough spot. If you're strictly, this is the part where I say, well, how does it relate to the consumer? If you're looking to figure out what should I do with my portfolio, do more research on the company itself, All of them talk about risk factors in their quarterly and annual reports. Take a look into that if you're curious about Apple. Like I have Restoration Hardware because they had some interesting quarter Q4 announcements from the earnings call. So you could take a look and you'll see, to our people and shareholders, it mentions here the year, the new, whatever, but they do go into risk factors and they talk about it. So I would say that's something to take a look at if you're worried about your particular portfolio. Let's say you're just worried about like, should I be investing overall? Then I think maybe kind of take a look at what the economic numbers are saying. I don't necessarily believe you have to be living and dying by the sort of, are we in a recession or are we not in a recession? There's numbers like inflation, like GDP output, like trade balance. There's a bunch of those things that can kind of give you an idea of how's the economy going, how's our productivity as a country, how are prices, how are people feeling, to kind of give you an idea of should I be really going gung-ho right now with my investments or should I be taking a seat back? And of course, analyzing where the price is to, buy low, sell high is there for a reason, but obviously it's not, you don't want to go full tilt on all-time highs and you don't want to be selling everything at lows either. So needless to say, unfortunately, I can't give you guys solid advice here, but I guess the idea is you always have to do more research. There's more behind the curtain than what is being shown. Don't let the article headlines fool you. I think there's a lot of details in the background. There's a lot of economic numbers coming out, a lot of reports that aren't even highlighted, like trade balance came out. And that's a huge, huge thing to show. How are we doing with other countries? How much are we exporting and importing? So keep that in mind. But the thing to remember is this. You can have a recession without having stocks collapse. You can have stocks fall without being in a recession as well, because the definitions are different. Recession is just declining economic numbers. What is it? It's so vague, it's stupid, that it's like a decline in economic activity over a few months. And the key part, again, to know is that you will, by the time they acknowledge you're in a recession, you would have already been in it for a couple months. You just wouldn't have known it because it wouldn't have been officially labeled. So that's a recession. Bear market, 20% fall. I think it's not just the 20% fall, but it has to continue staying in that range. Like it's not just you drop 20%, rebound back up. You have to be in it for a little bit too. But those definitions matter when you're keeping track of what are people saying, what are headlines talking to you about. And both are not great, obviously, but that's a topic for another video, I guess we'll put it that way. But obviously a recession, it can be tough because that impacts a lot more people at once. How do you kind of stay recession proof, so to say? It's something I've been saying in all my videos. Learning skills is the best way to really assure that you're always going to be in demand, that you're always going to be someone that companies want to hire. Being able to, when you apply, showing that you've done certain things, that you have the skills, maybe you're great at Excel, you're a great programmer, you're a great manager, whatever it is, doing all that. There's websites that'll help you learn stuff for free. I'm in the tech world, so I know all about the websites that'll help you learn to code and to learn all this stuff, but it doesn't have to be like a lot of things. It can't just be like, I want to be a great Java developer. I want to learn that skill. It can be, like I said, Excel. If you know Excel, it's a great tool that every company is going to use. It's not going away. Every company uses it and they're going to continue using it. So if you become a master of Excel, if you take a few courses, if you show some certificates, it's going to be something where when if recession comes and companies are having to cut back and all that, you'll be able to say, hey, I'm fantastic at this. This is my productivity. I've been able to do more, la-di-da-di-da. So that was the number one thing I would say is the best for you to do in order to prepare for a recession, is to just spend some free time learning some more skills, learning some more things that'll help you at your job, that'll make you a little bit more valuable. And when it comes to bear markets, just sit back and wait, really. This is not financial advice, by the way, but what I do is I sit back and wait. This is a ridiculous run. This is not for me to be buying. So I hope that clarifies a couple things. I hope that makes a little bit of sense. You guys can always drop comments and follow me on Twitter. Shoot me some messages. Hate mail is always welcome too. I'll talk trash back to you. I don't care. And if there's anything that's wrong, I got no problem with remaking the video and giving credit to whoever calls me out as well. So enjoy, folks, and hopefully this helped.